One of the most asked questions on Google is, will there be a housing market crash? Hi, my name is Mac Rogers. I'm a real estate broker here in the San Francisco Bay Area. Welcome to the channel. As this whole weird economy that we have is going through an intense shift, more and more people are asking about a possible housing market crash. Now, what better way to answer or explore this question by looking at what Robert Shiller has to say about this? In case you don't know or you are vaguely familiar with that name, Robert Shiller is the Shiller in the S&P Case-Shiller Index, so he knows a thing or two about houses. He is the expert of experts when it comes not only to housing but the economy in general. Back in the year 2000, he said that the stock market was a bubble, and guess what happened after that? The tech bubble burst. After that happened around the mid-2000s, he did a study that found that the housing market was also in a bubble. In around 2007, he said that it was about to burst. And we all know what happened after that. 2008 was when it all went to hell and the bubble actually burst. What we are experiencing right now, the amazing price appreciation brought about by the pandemic and cheap money, has a lot of people concerned. And as we head into the other direction, particularly in mortgage rates, how is the housing market going to be affected? And here's what Robert Shiller has to say about this. Quote, "Home prices haven't fallen since the 2007-09 recession. Right now, things look almost as bad. Existing home sales are down. Permits are down. A lot of signs that we'll see something. It may not be catastrophic, but it's time to consider that." If you guys follow the channel, you know I've talked about this on a regular basis. Home prices are still on the rise. I just did a market update video for the East Bay, and what it showed was prices are still resilient. Some places going down, but some places are still up. Shiller also mentions existing home sales are down. A drop in home prices, Shiller says, looks very possible. Quote, "The Chicago Mercantile Exchange has futures market for home prices that's in a backwardation now. Home prices are expected to fall by something a little over 10% by 2024 or 2025. That's a good estimate," Shiller said or told Yahoo Finance. "The risks are heightened right now for buying a house." I'm not too concerned about this expectation of prices dropping by 10% around 2024 or 2025. Basically, what this means is just prices will come down to where we are right now. In fact, if you look at home price appreciation for this year, it's just a little bit over 10%. If in 2023 we go up by another 5% and they are forecasting a 10% decline in 2024, that's not bad at all. And this is something that I do not understand when buyers or when my buyers tell me that they will want to wait for the market to go down. I often ask them, wait for what? For prices to come back to where they are now? Shiller also pointed out that on a national level, home price declines are rare. It happened in the early 1980s, then again in the early 1990s, and most of us remember the 2008 housing collapse. He points out that declines of 10% or more are rare. We've only seen this happen during the Great Depression and the Great Recession. So how can the housing bubble manifest itself? What are the elements or ingredients, if you will, of a bubble? The first one is speculation. This means investors trying to cash in on the ever-increasing home prices. While this has increased in the last couple of years, I would have to say that the degree of speculation that we have in this market is not the same as when it was into the 2008 bust happened. Nationally, if you look at the numbers, it's starting to be alarming and starting to climb up. Flipping homes have become hot again. Tons of investors and even corporations started buying single-family homes at record pace. In some states, home builders started overbuilding again and not waiting until they have buyers for homes. And the second element to a bubble is valuation or overvaluation. We are talking about price here. The ever-increasing double-digit home price appreciation that we've had in the last 2 years and even before that, you pretty much go all over the country and everyone is saying or in agreement that prices are sky high and homes are way overvalued. And according to 3 different studies from CoreLogic, Moody's Analytics, and Florida Atlantic University, we are already there. I have to say that I agree and I disagree at the same time. Yes, when you look at the market as a whole, meaning the entire United States, the prices of homes have far exceeded or has outpaced individual incomes. So in that sense, we seem to be overvalued. However, I would like to remind you that the housing market is very localized. And I'm going to contradict what I just said earlier. There is no such thing as a US housing market. That's an insane way of looking at the housing market. Every market is different. Different economies, different buyer profiles, different housing inventories, different income levels. To compare the housing market, say in the Bay Area and say Bozeman, Montana, and come to the same conclusion is totally irrational. Both markets could be overvalued, but it could be for several different reasons. I mean, the Bay Area has been overvalued or expensive ever since I got into real estate. This is primarily driven by our local or regional economy. The tech industry is the main driver of growth around here. There's also biotech and a host of other industries. Bozeman, Montana could be overvalued because lots of people moving there right now because of pandemic-related reasons. That's not sustainable. Look, I would argue that as expensive as it is to live here in the Bay Area, people can afford it. It's just a simple fact. If people can't afford to live here, prices would be plummeting. By the way, that doesn't mean we don't have a housing problem here in the Bay Area. All I'm saying is that there's true demand for housing at these prices, and there are a lot of people that can afford it. And the third element, according to Robert Shiller, of a bursting bubble is massive home price decline. This means 10% or more. He actually believes that double-digit declines are possible, but I think again in this instance, he is looking at it too broadly. I do believe that there will be certain markets that will experience massive declines that when you put all the numbers together, it may look like that the market as a whole is declining. And these places could be the usual suspects. These are places like Arizona, Nevada, Florida, and parts of Texas. Now I say parts of Texas because, Texas has been going through a lot of growth lately, not only from in-migration, but also because a lot of companies are moving there. So you have something besides in-migration that is driving growth. While in certain places like Arizona and Nevada just has so much land that all they do is build, and a lot of growth drivers are not driven by their local economies. And here's another thing. Many industry experts do not agree with Robert Shiller on this. Instead of forecasting a massive decline, some are forecasting appreciation, while others are just saying a very modest decline. Here are the companies that thinks that we are in for more appreciation, although slightly lower appreciation. The Mortgage Bankers Association, Fannie Mae, Freddie Mac, CoreLogic, and Zillow. All of these companies are predicting more appreciation in the coming years. Meanwhile, the following companies are predicting modest home price declines: John Burns Real Estate Consulting, Capital Economics, Zelman & Associates, and Zonda. So why the dichotomy? Why is it that one group sees further increase and one group sees decline? Well, for starters, financing is not what it used to be back when we had the mortgage meltdown of 2008. There are no subprime loans this time. Congress all but outlawed these types of loans after what happened. Also different is not only the type of financial product that's being sold to consumers, but the consumers themselves are different. Borrowers have less debt burden this time around. Their financial makeup or financial capability to pay a mortgage gets really scrutinized when you get a mortgage loan. Second reason why there are still companies that don't believe in a decline is because of our historic shortage in the number of homes for sale. Simply put, our population is growing and the sheer number of people looking for homes far outweighs supply. No amount of mortgage rate increases will solve this. It merely delays it. And the shortage is not just in houses being bought and sold, but also rental properties. This is also one of the reasons why rents keep skyrocketing. Yes, the reality is that the market is slowing down, but also the harsh reality is that houses are not getting cheaper, nor will they be cheaper anytime soon. In all likelihood, price growth will slow down compared to recent years. Upward pressure is still there because of the fundamental issue of supply not being solved. What's also certain is that not all markets will react the same. This means, like I mentioned earlier, there will be pockets of weakness across the country that will put the overall market down. And these markets are primarily the markets that had a lot of builder activity. Again, especially true in places where in-migration is what's driving home prices up. The experts on the other side of the fence, however, is seeing that there could be a possibility of oversupply by builders that is not being properly accounted for, and this is why they believe that declines are possible. But even this argument that they present for a downturn is primarily because of the cyclical nature of real estate and because of mortgage rates being high right now. In other words, once this mortgage rate increases, stops, and stabilizes, the demand could come back. And this is why they are only forecasting a modest decline, not a big crash. So, will there be a crash or a bubble that will burst? I feel like what's going to happen is that there will be markets around the country that might get severely affected. Possible huge price declines in the 10 to 15% range. And those markets might pull the overall market down. Meaning, if you look at the aggregate number, it seems like the whole real estate market is down. But when you drill down on specific markets, it's not the same story. So be careful when you're making your decisions. Base it on what's happening locally or where you're buying or selling and not looking at the big picture. Hey, thanks for watching. If you're looking to buy or sell here in the Bay Area, give us a call, a text, or an email. We would love to help you out. Have a great day.